All right, this is VIX Financial Strategy, and of course, it only makes sense that our first lesson is going to be covering the VIX. What is the VIX, you may ask? Well, it is the Volatility Index. Now, let's start here. Who calculates the Volatility Index? Well, it's the Chicago Board of Options Exchange, and there's a super complicated formula of how the VIX is calculated, but I just tend to break it down a little bit simpler here. I have 3 slides that we can go over really quickly, and then we'll go into how to use the VIX to the best of your abilities, how to make sure this is a big part of your trading strategy, and how to make sure if you're a long-term investor, you are aware of how to hedge your portfolio using the VIX. Now, the VIX measures the volatility of the S&P 500. The S&P 500, the SPX, is an index. You cannot buy shares of the SPX. You can buy shares of an S&P 500 ETF like SPY or ticker symbol VOO. There's a couple out there, but for the sake of the example, we're only going to be looking at SPX in its relation to the VIX. Now, back to the slides. The VIX is using calendar days, 365. Don't mistake it for a calculation based on the amount of trading days in a year, but it's actually based off the whole year. You can look at the VIX as a forward-looking measure. It is pricing in what the market expects for the S&P 500. Now, with that said, the VIX is a percentage point. So the VIX trading at 23, think of that as 23% or 23% move in the S&P 500. So for the sake of the example, I have it at 22. We'll just pretend it's 22. When the VIX is at 22, the S&P 500 is pricing in a move up or down of 22% within the next year. Therefore, it's an expression, not an actual number. So a couple ways that you can calculate expected moves while you're day trading is look at the VIX. If the VIX is very high, expect big moves up or down daily. I did some rough calculations. What you can do is take the number of the VIX, 22 for this example, and you divide it by the square root of 365. That will give you how much of a move the market is pricing in per day. Now you can do this with the week and you can do this with the month. Now, same thing, you take the square root of 52 because there's 52 weeks in a day, and you'll get an implied move of 3% a week. Same thing with a month, square root of 12, and so forth. You get the point. Now, I want to bring up this chart and go over this because this will help you get an understanding of volatility. Now, if you're watching this video and you're aware of the financial crisis that took place in 2008, 2009, you will recognize that we saw a big spike in the volatility index and we got up to 80 points or 80%. That means that the S&P 500 was pricing in a move up or down of 80% within the next year. Now, of course, during these times, we can look at the SPX back in 2008. Things got very, very volatile and things did bottom out eventually. And we did see a move above 80%. In fact, it was more than 80%. It was more than a double within that year. Now, same thing with the COVID crash of 2020. The VIX spiked. We saw that it came up to essentially similar levels, 80, high 70, 80%, and the VIX was an indicator of the volatility in the market. So we did double up. We actually went from, let's say, 2,200 points, 2,300 to above 4,000 within the next couple of years. Now, this is how you can understand when things are very fearful, the VIX is shooting up. Now, how do you trade this? How do you hedge your portfolio with this? Well, I have actually an example lined up. So I took a screenshot from my brokerage. I use Webull to trade. Let's just say I own the S&P 500. I own 500 of the largest companies in the US, and I think that things are going to get a little bit hairy in the next month. Things have been a little dicey lately, and we're coming up on a trend line that's a big resistance as we're in this bear market. My portfolio hasn't been doing too hot this last year, and let's say since we've recovered, I think we're going to make a next leg down. How do I hedge my portfolio? Well, I think that a move is going to happen by December 24th. So what do? I buy VIX call options. These are not the accurate price. This is the bid and ask spread. I took this screenshot during the after hours, so it's a little inaccurate. But for the sake of the example, we're only going to focus on the last purchase price. So let's say I bought a call option on the VIX at the 25 strike price and I got filled at 1.8. What that means is that I bought the 25, this is my strike price, and I bought it for 1.8. So we'll add 1.8 to our strike price, and that will give us our break-even price. So 25 plus 1.8 will give us 26.8. Let's just put a line to visualize for this example. Now, this volatility index will spike if the S&P 500 sells off. So I'm gonna hedge my portfolio by buying this call in expectation that the volatility index is gonna spike. Here's a couple reasons why that may happen. We have been in unusually high volatility days as we've dealt with COVID pandemic during 2020-21. We've had an elevated VIX ever since the war in Ukraine and Russia broke out. So things have been very volatile. And also we're going through a Federal Reserve rate hike all of 2022. So we can draw a couple trend lines, but I wouldn't pay too much attention to the significance of the trend lines because it's really news and circumstances that drive the price. It's not really the trend lines that drive the price of the VIX. Now let's say we were correct about the move, and the move looked something like this. We shot past our strike price, we shot past our break even, and we sold for a profit. Now what does that mean? That means the S&P 500 is selling off. What we did was place a hedge for downside while still keeping our shares for the upside. Now if we were wrong and that hedge was not the case and the VIX looked something like this, where it bounced around and actually collapsed and went the opposite direction, well then win-win. We still have our shares, we still have our S&P 500, we didn't have to sell it. And if the VIX is collapsing, that means the S&P 500 is rising. So inversely correlated. That's how you hedge with your portfolio. Now, if you're a day trader and you're swinging on news and you see some things developing in either it's domestically or it's abroad, you can trade the VIX for spikes in fear. How could you have done this perfectly? With a great elevated certainty. As you see news come out of COVID back in February, you could have been buying the VIX call options. You could have been getting fills anywhere down here in the 20s to sell them later for anywhere for a double in the 50s or even more. So that's how you can hedge your portfolio, but also trade in this somewhat of an asset class. The main point of this video is give exposure to the volatility index and educate you guys that this asset class is tradable with options. So that will wrap it up for today. Thanks so much for watching. Follow me for more and stay tuned for the next video.